Yesterday, we didn't just see a red candle, we saw a crime scene. Silver just experienced the worst single-day crash in commodity market history. Not the 1980s, not 2011. This is worse. And if you're sitting there thinking, wait, didn't silver just hit $75? You need to stop right there, because that's exactly the confusion I'm going to clear up in the next few minutes. And understanding this difference could be the difference between panic selling at the bottom or buying the opportunity of the decade. Let me be crystal clear about what actually happened. Silver did not peak at $75. That number you heard? That was the bottom of the crash, not the top. On Thursday, January 29th, 2026, silver hit an all-time high of $121.64 per ounce. By Friday afternoon, it had crashed to $76.67. That's a $45 wipeout, a 37% drop in 48 hours. To put this in perspective, the infamous Hunt Brothers collapse of 1980 was 78%, but that took 2 months. The 2011 margin crisis saw a 46% drop over 15 trading sessions. What we just witnessed compressed months of carnage into a single 2-day window. This is what happens when algorithms, leverage, and human panic collide in modern markets. By the end of this video, you will know exactly who pulled the trigger, why the banks are involved, and whether this is the end of the silver bull run or the greatest trap ever set for retail investors. But before we decode the 3 culprits, I want to know the sentiment of this channel. Did you panic sell yesterday, or did you buy the dip? Go to the comments right now and type either sold or bought. I want to see who held the line when the market was bleeding. Now let's rewind the tape and reconstruct this massacre wave by wave, because this didn't happen all at once. This was a carefully orchestrated execution in 3 distinct phases. Wave 1 began on Monday, January 26th. Silver was trading at $109.54 at 8:45 a.m. Eastern Time. Traders were euphoric. The metal had been smashing through resistance levels for weeks. By Monday evening, silver spiked to an intraday peak of $117.54, and then, in just 4 hours, it tumbled 13% to $102.52. A $15 swing in 4 hours. That should have been the canary in the coal mine. But everyone ignored it because they were too busy counting their unrealized gains. Then came Tuesday, January 27th. This is when the CME Group, the Chicago Mercantile Exchange, announced they were raising margin requirements. They increased them from 9% to 11% for standard accounts, and from 9.9% to 12.1% for high-risk profiles. This went into effect on January 28th. Now, if you don't trade futures, let me explain why this matters. When you buy a silver futures contract, you don't pay the full price up front. You post collateral called initial margin. For a standard 5,000-ounce contract trading at $110 per ounce, that's a notional value of $550,000, you might only need to post $25,000 to $27,000 in margin. The CME's announcement meant traders suddenly needed an extra $7,500 per contract just to stay in the game. If you were holding 10 contracts, that's a $75,000 cash call overnight. And if you couldn't pay, your broker liquidated your position, forced selling, which drives prices lower, which triggers more margin calls. A cascading liquidation spiral, and this wasn't even the first margin hike. Back on December 30th and 31st, 2025, the CME had already raised silver margins by 30%, from $19,000 to $25,000 per contract. That triggered an 11% single-day plunge on Monday, December 30th. So we'd already seen this playbook, but greed had short memories. Wave 2 was the calm before the storm. Wednesday, January 28th, silver recovered to test the $114 to $116 range. Traders thought they'd survived the worst. That's when Marko Kolanovic dropped a bomb. Kolanovic, the former JP Morgan chief market strategist, published research on Wednesday evening predicting that silver would drop 50% from these levels within a year. He cited bubble dynamics and historical commodity cycles. Now, here's where it gets interesting. Kolanovic left JP Morgan in 2024, but JP Morgan is the primary custodian of the iShares Silver Trust, the world's largest silver ETF. Was this luck? Or did he know something the rest of us didn't? Thursday, January 29th. Silver spiked to that record high of $121.64 intraday, then closed around $113.84. The volatility was insane. $10 intraday swings had become normalized. The market was exhibiting all the classic signs of a parabolic blow-off top. But nobody wanted to believe it. Wave 3 was the execution. Thursday night, January 29th, 11 p.m. Eastern Time, reports surfaced that President Trump would nominate Kevin Warsh as the next Federal Reserve Chairman. And this is the moment everything changed. Who is Kevin Warsh? He's a former Federal Reserve governor who served from 2006 to 2011. right through the 2008 financial crisis. He's a Stanford-educated lawyer, former Morgan Stanley executive, and known as an inflation hawk who prioritizes price stability over employment. For weeks, the market had been pricing in a captured Fed, a collapsing dollar, emergency rate cuts, and money printing infinity. The Warsh nomination flipped that narrative in seconds. It signaled that Fed independence would remain intact, that rate cuts weren't guaranteed, and that the dollar debasement trade was dead. Within hours, the U.S. dollar index spiked 0.9%, its largest single-day gain since May 2025. For silver, priced in dollars and held as an inflation hedge, this was a double-barreled assault. The nominal price advantage evaporated, and the fundamental narrative justifying extreme valuations lost all credibility. Friday, January 30th, 4 to 8 a.m. Eastern Time during the Asian session, algorithmic selling kicked in. Silver cascaded from $114 to $95 within hours. Then, at 9:30 a.m., when New York opened, full panic mode. Silver plunged from $95 to an intraday low of $76.67, a 37% decline from the previous day's peak. Over $120 million in forced liquidations across derivative markets. The carnage was biblical. There was a partial recovery attempt between noon and 2 p.m., bringing prices back to the $83 to $86 range. But late session selling pushed the metal back towards $78.53 by the close. February, silver futures settled down 31%, spot silver down 37%, the worst single-day performance in commodity market history. As Christopher Wong, strategist at Overseas Chinese Banking Corporation, said, it validates the cautionary tale of the fast-up, fast-down nature of the moves seen in gold and silver. Now here's where Economic Decoded provides value beyond the headlines, because the Warsh nomination and the margin hikes are only part of the story. There's a hidden war happening between paper silver and physical silver that almost nobody's talking about. And it's this disconnect that reveals whether this crash is the end or just the beginning of something much bigger. Let me explain what was happening beneath the surface. By mid-January 2026, a bizarre phenomenon had emerged. Physical silver in Shanghai was trading at a 40% premium to paper silver in New York and London. On January 30th, as COMEX silver crashed to $76 to $92, Shanghai metal market spot prices held at $120 to $130 per ounce. This is the most extreme dislocation in modern precious metals history. Think about what this means. In Shanghai, people are paying $130 for physical silver. In New York, paper contracts are trading at $76. Same metal, $54 spread. How is that possible? Because the futures-based pricing system centered in New York and London is losing its connection to physical reality. Here's why. On January 1st, 2026, China reclassified silver from an ordinary commodity to a strategic resource subject to government licensing. Only 44 companies received authorization to export silver. That's gatekeeping over approximately 121 million ounces of annual exports, representing 60 to 70% of refined silver traded globally. China exported 5,100 metric tons of silver in 2025, the highest since 2008. Now they're putting restrictions on it. Why? Because silver isn't just money. It's the structural metal of the green energy future. Solar panels, electric vehicles, AI data centers, 5G infrastructure. China knows this, and they're hoarding it. At the same time, silver lease rates, the cost to borrow physical metal, spiked to 8% annualized by mid-January. Historically, these rates sit near zero. When someone is willing to pay 8% to borrow silver for short-term delivery, it means the physical market is screaming for metal that doesn't exist. And here's the kicker. Between early and mid-January, 33.45 million ounces of silver were physically withdrawn from COMEX registered vaults in just 7 days. That's 26% of total registered inventory. People were taking delivery, draining the system. And the CME responded by hiking margins, a move that disproportionately hurts long speculators while protecting institutional shorts. This raises the question, was this crash purely market-driven or deliberately engineered? Let's talk about the elephant in the room. JP Morgan. In 2020, JP Morgan paid $920 million in fines to settle charges of multi-year precious metals manipulation through spoofing, placing and canceling fake orders to manipulate prices. The bank neither admitted nor denied wrongdoing, but the settlement confirmed systematic manipulation occurred throughout the 2010s. During that entire period, silver repeatedly failed to sustain moves above $50. Marko Kolanovich's prediction came just 2 days before the crash. Kolanovich, who spent years at JP Morgan. JP Morgan, which is the primary custodian of the largest silver ETF. JP Morgan, which paid nearly $1 billion for manipulating these exact markets. Commitment of traders data from mid-January showed large commercial traders, typically banks and bullion dealers, held concentrated short positions that would profit handsomely from a price crash. One analyst noted, hedge funds and large financial institutions expressed concerns over deteriorating trading conditions. These significant market players cut net, long by one in the week leading up to Tuesday, January 27th. The historical pattern is undeniable. In 2011, COMEX increased margin requirements 5 times in 8 days, a 150% total increase, which directly precipitated silver's crash from $48 to $35 in 10 trading sessions. In 1980, the introduction of Silver Rule 7 restricted margin buying and triggered the Hunt brothers collapse. Now, in 2026, we see the same playbook. Massive rally, margin hikes, cascading liquidations, crash. Is it manipulation? The CME maintains that margin adjustments reflect volatility-based risk models designed to protect clearinghouse solvency. Maybe. But the timing is awfully convenient. Now let's talk about what the experts are saying, because the divergence in opinions reveals just how uncertain this moment really is. Robert Kiyosaki, the Rich Dad, Poor Dad author, had been warning his followers for weeks. On January 21st, he tweeted, "Silver is $92 an ounce and growing more vital as the structural metal of the world's economic future." As silver broke $100, he warned against FOMO. If you are planning on investing in silver, be patient. Wait for a crash, then go or no. That advice proved prescient. His long-term view remains extraordinarily bullish. I believe silver is just getting started, and I believe $70 to $200 silver could be an outside reality in 2026. He outlined a tactical exit strategy. I will buy silver up to $100 and wait. The sellers will crash the silver market. I'm planning on trading my silver for gold. His warning? Pigs get fat, hogs get slaughtered. Peter Schiff, Euro-Pacific Capital founder, maintained his bullish thesis even at record highs. In a January 27th interview, he framed the rally as a signal of deeper stress in the global fiat system. He predicted silver would hit $100 by 2026, stating it could go quite a bit north of that. Schiff's analysis emphasized that silver's breakout above the $50 to $70 resistance zone had set a new floor, suggesting even a correction would find support well above 2024 levels. Michael Burry, famous for predicting the 2008 crash, took a bearish stance on speculative assets in early 2026, though his focus was on AI stocks rather than metals. He was shorting Nvidia and Palantir, calling the tech surge a bubble. His broader positioning suggested caution toward momentum-driven assets. Among institutional analysts, the divergence is shocking. Citigroup published research in late January predicting silver would reach $150 per ounce within 3 months, potentially hitting $170 if the gold-silver ratio returned to 2011 extremes. Citi described silver as gold on steroids or gold squared. Their forecast was the most aggressive among major financial institutions. Notably, it was published on January 28th, just 48 hours before silver crashed 37%. Meanwhile, Bank of America published research ranking silver as having the highest bubble-like asset dynamics of any major commodity, with prices approximately 30% above long-run fundamental averages. They warned the final leg of the rally appeared driven by sentiment rather than scarcity. Goldman Sachs maintained a cautious stance, with their forecast implying silver in the $75 to $85 range. They warned that soaring prices and volatility had strained traders' risk models, creating conditions ripe for rapid deleveraging. Bloomberg's macro strategist Simon White noted, "The silver-gold ratio has climbed almost as much as it did in the late 1970s, and today's dramatic moves show that might have marked a rejection point." The analysis emphasized that the extent of the correction suggests market participants were simply waiting for an opportunity to take profits. CNBC featured Katie Stoves of Mattioli Woods, who said, "This likely indicates a market-wide reassessment of concentration risk. When everyone is leaning in the same direction, even strong assets can experience sell-offs as positions are unwound." So where does silver go from here? Technical analysts have identified 3 primary support zones. Primary support is at $100. This is the psychological level silver broke for the first time in history on January 23rd, 2026. As of January 30th and 31st, spot silver trades around $84 to $86, about 15% below this level. If silver can reclaim and hold $100 on a weekly closing basis, it signals the correction exhausted itself. Secondary support is at $93, which was the January 14th peak before the parabolic advance. This level coincides with the 50-day exponential moving average. A sustained hold above 93 would indicate the structural bull market remains intact. Critical support is the $70 to $80 zone. This represents the consolidation platform established in December 2025. Technical analysts widely view $70 as the line in the sand separating a bull market correction from a potential bear market reversal. A weekly close below 70 would likely trigger another leg of selling towards $60 to $65. Let me give you the bull case. Despite the carnage, powerful structural factors support the view that this correction is a buying opportunity within a secular bull market. Number 1, unprecedented supply deficit. Silver is entering its 5th consecutive year of supply deficit. From 2021 to 2025, there's been a cumulative shortfall of approximately 820 million ounces, equivalent to an entire year of mine production. The Silver Institute projects the 2026 deficit will reach 200 million ounces as Chinese export controls tighten available supply. Mine supply peaked in 2016 at roughly 900 million ounces annually and has declined to approximately 830 to 850 million ounces, while total demand has grown to 1.17 billion ounces. Number 2, industrial demand acceleration. Unlike gold, silver possesses unique industrial properties that make it irreplaceable. Solar photovoltaics. Each panel requires approximately 20 grams of silver. The International Energy Agency projects solar capacity will quadruple by 2030. Electric vehicles. Silver demand has increased 500% since 2015. Each EV contains 25 to 50 grams compared to 15 to 28 grams in internal combustion vehicles. AI and data centers require silver for high-performance connectors and power distribution. 5G infrastructure consumes significant silver in antenna systems. This industrial demand provides a hard floor under prices that didn't exist in previous speculative bubbles. Number 3, China's strategic stockpiling. China's reclassification of silver as a strategic resource signals Beijing views the metal as critical to technological security. With only 44 companies licensed to export and China dominating 70% plus of global solar panel manufacturing, Beijing may prioritize domestic consumption over exports. This resource nationalism effectively removes 60 to 70% of refined silver from Western markets. Number 4, central bank diversification. Multiple emerging market central banks, Russia, India, Saudi Arabia, have begun adding silver to strategic reserves alongside gold. While central bank silver buying remains a fraction of gold purchases, even modest allocations from sovereign wealth funds represent substantial demand given silver's smaller market size. Number 5, mean reversion in the gold-silver ratio. The ratio currently sits around 60 to 1. During previous silver bull markets, this has compressed dramatically. In 1980, it hit 15 to 1. In 2011, 32 to 1. If gold continues toward $5,500 to $6,000 as major banks forecast, and the gold-silver ratio mean reverts even modestly to 50 to 1, the implied silver price is $110 to $120. A compression to 40 to 1 would imply $137 to $150 silver. Bullish price targets? Conservative, $100 to $120 by mid-2026. Base case, $125 to $150 by Q4. 2026, optimistic, $170 to $200 by late 2026 or early 2027. Now let me give you the bear case, because ignoring it would be intellectually dishonest. Number 1, Federal Reserve staying hawkish. While markets had priced in 3 to 4 rate cuts in 2026, the Warsh nomination combined with persistent inflation suggests the Fed may maintain higher for longer policy. Higher real yields increase the opportunity cost of holding non-yielding assets like silver. Number 2, dollar strength reasserts. The dollar's January collapse to 4-year lows reversed sharply on the Warsh news. If the new Fed chair maintains credibility and global growth weakens relative to the U.S., the dollar could rally further, historically negative for commodities priced in greenbacks. Number 3, global recession hitting industrial demand. JP Morgan's 2026 economic outlook forecasts a 35% probability of U.S. and global recession. If manufacturing activity contracts sharply, especially in China, demand could crater. The 2008-2009 precedent is instructive. Silver fell from $21 to $9, a 57% decline as industrial demand collapsed. Number 4, speculative positioning unwinding. Commitment of traders data showed large speculative longs at historically extended levels before the crash. During the 2011 silver crash, it took weeks for positioning to fully normalize, with prices continuing to drift lower. Number 5, technical breakdown below key support. Breaking $70 would likely trigger algorithmic selling, targeting $60 to $65. A break of the 200-week moving average at $55 would shift the narrative from correction in a bull market to bear market beginning. Number 6, Hunt Brothers/2011 precedent. After 1980's collapse from $49 to $10, silver didn't return to $49 until 2011, a 31-year wait. After 2011's crash from $48 to $26, silver took 9 years to reclaim those levels. Charlie Bolello, chief market strategist at Creative Planning, warned, "Silver prices have now tripled over the past year, their biggest year-over-year gain since the Hunt brothers attempted to corner the market in early 1980. The rally in 1980 concluded in disaster. By 1982, silver had depreciated 90% from its peak. Bearish price targets? Conservative, $70 to $75 by Q2 2026. Base case, $60 to $65 by mid-2026. Catastrophic, $50 to $55 by Q4 2026 if we get a global recession combined with a dollar rally." So what's the most likely outcome? I believe we're looking at volatile consolidation in the $80 to $110 range for several months before resuming the broader uptrend toward $125 to $140 by year-end 2026. This assumes the Fed cuts rates 2 to 3 times, the dollar stabilizes in the 95 to 100 range, global recession is avoided, supply deficits persist, and geopolitical tensions remain elevated without major conflict. Under this scenario, the January 30th crash represents the capitulation event that clears excessive speculation, allowing fundamentals to reassert over the medium term. Silver trades heavy for 2 to 3 months as the market digests the correction, then gradually grinds higher as supply constraints and industrial demand provide support. Here are the lessons from the silver massacre. Parabolic moves are unsustainable. Silver's 37% gain from $88 to $121 in 6 days violated every principle of sustainable market behavior. Leverage amplifies both gains and losses. Margin-based speculation magnified returns during the rally, but created cascading liquidations during the crash. Narrative shifts happen suddenly. The Warsh nomination flipped the entire market story in hours. Physical paper disconnects, signal stress. The 40% Shanghai premium represented a fundamental breakdown that hasn't disappeared. Historical precedents matter, but context differs. And institutional forecasts are not guarantees. Major banks issued wildly divergent targets from $75 to $200. As of January 31st, 2026, silver trades at approximately $84 to $86 per ounce, down 30% plus from the peak, but still up over 180% from January 2025 levels. The metal sits at a critical juncture. Either the correction exhausted itself and fundamentals reassert, driving prices back above 100 toward 125 to 150, or the crash marks the beginning of a deeper bear market that tests 60 to 70 over coming months. This was a liquidity flush, not a fundamental change. The supply deficit is real. The industrial demand is real. China's export controls are real. The question is whether the paper market can continue to suppress prices when the physical market is screaming for metal. If you want to stay ahead of the algorithm and understand these dynamics before they play out, subscribe to Economic Decoded. Hit that notification bell and comment "Diamond Hands" if you're still holding through this volatility. The silver market has delivered its verdict on excessive speculation and leveraged positioning. Whether it has also rendered judgment on the structural bull thesis remains to be seen. History suggests patience rewards those who buy physical during panic, but only if the fundamental story remains intact. Time will tell which narrative, bull or bear, ultimately prevails. This is Economic Decoded, and I'll see you in the next investigation.